Hi, I'm Alessia Di Camillo from Tenax Capital, and I'm here today with Marco Della Giacomo, Portfolio Manager, and Thomas Baltas, Credit Analyst. After a surprisingly strong year in credit, we take the chance to review the most critical moment for the market and for Tenax Dynamic Income Fund. Marco and Thomas, could you provide us with an overview of the credit market in 2023, particularly for financial and corporates?
Of course. Starting with financials and focusing on 81s or COCOs, the year has been quite volatile and characterized by two main events. The first one has been the collapse of some US regional banks in early spring 2023. The second one was linked to the UBS takeover of Credit Suisse that led to the collapse and cancellation of their 81s in the market. That led to a loss of confidence of investors in the whole 81 asset class, and it took the ECB and the EBA some statements to reassure on the regulatory framework of 81s to make sure confidence came back to the market. We then had the market reopening in September with several new issuances at very generous premium to make sure that the market came back to normality and eventually ended the year with one of the best performance ever.
On corporate credit and high yield in particular, the year can be categorized by negative sentiment or even fears of consumer weakness, refinancing hurdles, and recession that would have weighed a lot on the high yield names. But actually what we've seen is companies managed quite well, and they cut costs to preserve margins in an inflation environment. And most importantly, companies adopted conservative balance sheet policies to preserve liquidity and avoided the need to tap the bond market in these higher yields.
And how did the Tenax Dynamic Income Fund perform in this credit environment, and which have been the key drivers?
Sure, the fund did very well. The underperformance was 12.7%, which places the fund comfortably in the top quartile of the Morningstar Euro High Yield bucket. A key driver of this have been our positioning in the 81 environment. We invested in short calls and into high convexity names in the aftermath of Credit Suisse takeover. During the year, we then extended the duration of our investments in 81, and then we took advantage of very attractive new issuance premium from September onward in the space.
We also had a very successful year on bond selection. Among our top picks, we have names like IMS Osram, Jaguar Land Rover, Forvia, and Carnival. And to give a bit of a flavor on those names, IMS Osram had a volatile beginning of the year and spreads widening quite a lot, but we had good grounds to believe in the credit story. And we held our position during the year and increased a bit until MS Osram launched the full refinancing in November and tendered the bonds above par. Jaguar Land Rover and Forvia was another excellent example of us taking a bet on automotive sector recovering from COVID and supply chain issues. Moreover, both companies delivered quite successfully on their idiosyncratic targets and improved their credit profile by focusing on cash flow generation and debt reduction. Carnival, a cruise ship company, was another excellent example of a company that suffered from COVID-19 travel restrictions. However, supported by strong fundamentals, position in the market, good cash levels, and excellent access to both debt and equity markets. They've now recovered and showing record earnings and rapidly improving the balance sheet.
So Thomas, is there any specific area in the high yield market where you feel more confident entering into 2024?
Sure. Well, at the outset, we think the high yield market is still a very attractive place to be from risk-reward perspective. The outperformance will require balancing market timing and positioning. Well, at the end of 2023, we had 2 months of very strong rally that changed the perspectives a little. Our expectations for the future got front-loaded into spreads, making them quite vulnerable to any negative development against the consensus. On top, financing costs are going down from the last year highs. However, it's still above the levels that most of the companies are paying for on their debt, making refinancing still a concern. As such, we would favor adding exposure into companies that do not have a material debt maturing over the next 12 to 24 months or have proven access to the market. We're cautious adding exposure to weakest cyclical names, as consumer demand could still suffer. To capture more attractive yields, we would not mind adding exposure to more levered but stable companies, provided they maintain a conservative way to manage the balance sheets. But in general, we think the first part of the year should be managed in a more defensive way, and we would target to increase exposure once spreads widen on the back of any earnings disappointment or slower economic growth.
So Marco, to conclude our discussion to Dynamic Income Fund, why do you think it continues to represent a good investment opportunity?
Sure. Well, first of all, we will maintain a disciplined approach within the high yield bucket. We are not chasing yields. We want to invest where we see value. And we are not afraid of concentrating our exposure into a few names where we have the highest conviction levels. On the financial subordinated bucket, we will keep an exposure to AT1s and RT1s. We focus on core Europe or peripheral national champions. We build models to allow us to assess the extension risk on those securities and to understand when the extension risk becomes actually an extension opportunity. Those models have allowed us to spot some arbitrage opportunities either within the capital structure of a single name or across the curve. In terms of positioning, after the rally of spreads and rates of the last 2 months of last year, we entered 2024 with a barbell approach. On the one side, we have high beta, high spread names. On the other, the short end of the rates curve. We did that to build an insurance against potentially higher rates volatility, especially in Europe, where we believe there was too many cuts too soon priced from the market. We will then look to increase the duration profile of the fund as we go throughout the year to take advantage of a clearer rates path.
So thank you, Marco and Thomas, for sharing your perspective today, and we hope that this has provided you with a valuable insight into the credit market.